Hi, everybody. Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania. We wanted to do the first of the month update, and it is February 2023. The groundhog saw his shadow, so he's trying to tell us there's going to be 6 more weeks of winter. I don't believe him because today it's 55 degrees here in Pennsylvania. But it's again the first of the month update. And what do we want to talk about? I want to talk about what's on everybody's mind right now. We are in the midst of fourth quarter earnings season. And basically, you can see by my cartoon that coming into earnings season this year, it was really a mixed bag. In the fourth quarter, everybody, all the market pundits were talking about how earnings were going to be so bad. Tech companies were laying people off and earnings are going to be horrible, etc. Earnings have not been that bad in the tech world. And in other parts, for example, the energy world, earnings have been phenomenal. We got some reports this week by some major Dow 30 companies that earnings were much better than expected. So a lot of people are looking at earnings and saying, what the heck's going on? They're not dropping off the cliff, are beginning to realize that the stock market is started out 2023 with a bang. So we obviously finished 2022 on a poor note, but so far for the first 6 weeks, we have the S&P 500 up just about 8.5%. Through the end of January, the S&P 500 was up 6%. The NASDAQ is exploding. We have the NASDAQ through the first 6 weeks of the year, almost 16%. Now, what do I think is going on in the NASDAQ and also the S&P 500 is that a lot of these large cap tech companies, Microsoft, Apple, Google, Amazon, etc., and this is not an endorsement to buy them. We just want to use those names as a comment. Many of those companies were sold down viciously in the fourth quarter, and they have really rebounded because earnings, although were okay, they weren't great, they didn't fall off the cliff. So we're starting out the new year in a much stronger format. January, we saw a good rebound in the markets. February is continuing to add to that. Even though we had Chairman Powell come out this week, he actually said some positive things where he believes that inflation is beginning to roll over. We agree entirely with that. And we think the bond market is also sending that signal as well. So one of the problems that we had last year was that interest rates went up so quickly. The Fed cranked up short-term interest rates and long-term interest rates. We saw the average bond fund down about 15% for 2022. Well, guess what? Before 2022, the worst year for an average bond fund was down only 4%. So last year was bad because both stocks and bonds were down literally in the mid 15% area. Now, this year, we've seen the stock market start off on a good note. We've also seen the bond market start off on a good note, too. We have seen yields ease down to about the 3.5% range. Currently, they're about 3.6% on the 10-year Treasury. Now, one of the things that we're going to talk about is that everybody's looking for a big rebound in the bond market with big returns this year. We believe that they're going to be more muted. I am looking at the bond market and saying you're going to make 3.5% to 4.5% this year on your bond portfolio. You're not going to make back 15% all at one time. I believe over the next couple of years, you're going to see bonds do what they're supposed to do, give you a nice coupon, and also provide your portfolio with some way to lower volatility that may be due to the stock market. So bond market's doing well. Actually, yields on a lot of short-term fixed instruments are up. We've been pounding the table the last couple of weeks on bank CDs. You're now getting paid on short-term bank CDs over 4.5%. We think that's attractive. We think tax-free bonds are attractive. So we think the bond market's going to go back to doing what the bond market should do, is provide some nice income for people in 2023. So what does it mean when the equity markets start out the year with a bang? Well, so goes the January, so goes the year. If you remember last year, January, the market started to roll over. February, we had the Russian invasion of Ukraine, and it was all downhill from there. Now, having said that, my target for the stock market this year was about a 6 to 8% return in 2023. We've already reached that, in some cases exceeded that. Now, does that mean you sell all your stocks and go home? Not necessarily, because one of my other themes last year was how bearish everybody was. Well, Gallup just did a poll last week, and the results of the poll show that the American investor is still extremely bearish. They don't believe the current rally that we're in. They don't believe that the U.S. economy is going to continue to hold up the way it is, and they don't believe that interest rates are stabilizing. So again, we're getting this bearish sentiment out there, which could cause the stock market to ramp up another 5 to even 10% in the first half of 2023. So again, January started off great. We are seeing the rally continue into February. Fourth quarter earnings were not as bad as everybody thought they were going to be. And in some sectors, especially energy, we've had some blowout earnings there. Again, this is the most widely anticipated recession I have ever heard talked about in my career. Everybody's saying that we've got to be going into a recession in 2023. My personal view is that it looks like the recession is being pushed off. If any of you follow the investment news media, you'll see that last week we had a blowout jobs number with over 500,000 jobs added in the month of December. Now, will there probably be some adjustments in the following months? Because again, when they report the March jobs numbers, they can go back and revise the December and January jobs numbers. So always a little hint. Always look at the revisions to see if the revisions are coming down or the revisions are going up. I have a tendency to believe that January's job number, the hot number of over 500,000 jobs added, is probably going to be revised down, but may not be revised down that much. But the point I want to make about the jobs number is that you don't get a major recession when you have the U.S. job market as strong as it is. So again, the big theme that everybody's been focusing on has been earnings, the jobs number, and also inflation. Next week, we get the CPI number, a reading of inflation. Again, we believe that all of the inputs that you're seeing in inflation are coming down. Everybody's been worried the last couple of months about egg prices. Wholesale egg prices have plummeted in the last 2 weeks. You're not going to see that at the grocery store for about another month. But again, another input as far as inflation is coming down. So again, we think that the surprise is still on the upside. I would not be surprised to see if we have a little bit of a pullback here because we have gone so far so fast. But again, the overwhelming bearish sentiment is really overriding any concerns about earnings, the recession, or inflation at this point. So that's our first of the month update. As always, you can get our slide deck that you're seeing here by downloading my app. Just text Chris E, CHRISE, to 36260 to download my app. And we'll be back with another update soon. Thanks for watching.